Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil this morning, essentially little changed, unchanged at $67 a barrel. Prices have been somewhat kind of stuck or in limited range since the end of the Israeli war on Iran, and the market gave up a lot of that geopolitical risk and now seems to be stuck or fixed in and around 66, 67, a little bit higher, it has to be said, than where it was before the Israeli war in Iran, but still essentially back in the area. I want to kick off this morning with Neil Atkinson, former head of oil markets division at the International Energy Agency. Neil, I wanted to get for you to give us your thoughts on a commentary that emerged yesterday and has been emerging more often in recent weeks as we get closer to the OPEC Plus meeting decision on July 6th. The question around reliable data. Last year, we saw a massive divergence between IEA and OPEC, just two headlines on how divergent forecasting research was. Now there's reporting that secondary sources have fallen into a similar vortex of not as reliable as one would like. And so ultimately the market reaction to the recent 3 months of accelerated increase by OPEC Plus didn't quite jolt the market because there was a lot of confusion around the data. I want to get your thoughts on that. Of course, former head of oil markets division at the IEA, at the forefront of this business for many decades. Your thoughts on that narrative as we go into the next OPEC meeting?
Okay, great. Here's two targets that I can give a good kicking to immediately.
Yes.
Excellent. First thing, secondary sources. They are completely comprised of educated guesswork. They always have been. And in the days when I worked for Petroleos de Venezuela in the mid-90s in London, one of my jobs was to, shall we say, steer the market away from the truth, I think is the kindest way of describing it, because we were producing in excess of our quota. Now, today, the secondary source data is better educated and better informed because the tanker tracking, the satellite tracking is way more sophisticated than it was 30 years ago. However, the secondary sources are only reporting on what they see as far as trade is concerned. They have to then make assumptions about the level of, for example, crude oil going into refineries to build a picture of what they think wellhead production might be. So it is educated guesswork, and it is no more than that, but it is a guide and people use it. Quickly, because I'm ranting a bit here, as far as the IEA OPEC data is concerned, the IEA in 2024 was far closer to the truth as far as global oil demand growth was concerned. Their record in the end was actually pretty good. OPEC started out for 2024 with a massive year-on-year increase in demand expected. They pared it back to some extent as the year went by. But I've been critical of both agencies with respect to their medium and long-term outlooks, which I think reflect them both talking their different books. So, you know, the IEA and the other agencies are there to be kicked from time to time by people, but people should not forget, finally, Sean, I promise, that the IEA particularly does an enormous amount of work with non-OECD countries to try and improve data gathering and data processing and timeliness. They hold seminars in the countries, they give guidance on best practice. So the IEA works very, very hard in this respect. And some of the commentary, I'll be writing back to some of these people on LinkedIn in due course. Some of the commentary is just plain flat out wrong.
Ali Al-Rayami, consultant and former Director General of Marketing at the Ministry of Energy and Minerals, Oman. Your thoughts now, Ali, as we are some days away from OPEC Plus, or the 8 countries within OPEC Plus that are the curators of what was 2.2 million barrels a day of cuts, which is now I think one would have to say, is it probably less than 1 million barrels left of those cuts? Your expectation for the decision this weekend, and what do you think they should do, and what do you think they will do?
I think, we have already seen some increase for the last few months, and have already unwind a lot of oil from 168 or 169, I think, that was agreed before, to 411 on a monthly basis for the past 3 months. And now it is just cream on the cake, and they will continue for until they finish the whole 2.2. I think you're right. The amount or the volumes left, it is almost like what, maybe 800,000 or 850,000 barrels left. So it is just a matter of 2 months until October, maybe the beginning of October. Then the whole 2.2 million barrels will be disappeared. And the question is always that it's the market is ready to accept these volumes, and the result so far shows that we don't know the numbers exactly, and we don't know how many volumes are already reached to the market, but the expectation from the media and also from the market movers, it shows that yes, the price is already, or the volumes are already been priced in the what we see now on a daily basis. So expectation, the market has already accepted the idea of having this 411 on a monthly basis. To me, I think the fundamentals, so these are the right thing to monitor in the coming few months and few weeks. I think so far we are in the summer season, and we know that the troubles, and also the summer vacations, and people tend to go left, right, and center. But nevertheless, that I don't
Places
think
like Zanzibar and other exotic
places like
locations.
Vienna. I'm going to Vienna
Like
next
Vienna,
week, so,
exactly.
yeah.
Bring
I
your
will
air
leave,
conditioner with you. It's
not
pretty
during
hot, and they don't have any AC.
not during my time. I think I checked the forecast. I think it looks good during
Good.
that period. But anyway, I mean, I don't think that there is a problem on
And just on that
inventories.
point, Ali, the two parts to my question. What do you think they will do, and what do you think they should do? On the should part, do you think they should continue?
They should continue. I mean, you started this rally, and you started the open up of the volumes to the market. Then I think you should continue to the end. And this was my idea from the beginning. I said if they are going to do this, then they have to do it all the way until they finish the 2.2. And this seems to be the right decision at the moment. The market is already accepting the idea already.
Jamie Ingram, managing editor at Middle East Economic Survey. Jamie, your thoughts? We've come through this first half of the year, quite a turbulent first half, with all of the context of trade wars and literal wars, and now we look to the second half of the year with a few of the ingredients still present. But on the decision that OPEC Plus is making this week, it's ultimately on the output quotas for the 8 countries in August. That's the decision that will be made on July 6th, which means adding 400,000 barrels to quotas in August, which ultimately means, if you translate that into supply, that would be supply that would probably be physically delivered to the market in October or something to that effect. Your thoughts on the sort of overarching second half of the year with this supply cycle increase?
Hi, Sean. Yes, yeah, you're right. They're meeting this weekend to decide their August quotas, which, yeah, there will be a delay on when that hits the market. Maybe we can be a bit more charitable and say it would be more like September when some of these barrels would be loaded. But yeah, essentially, it is for volumes that will then hit the end consumer late into Q3, possibly even into Q4 when we're entering a weaker demand cycle. But at the moment the futures market is already trading. What are we on now? they'll be trading August barrels now as the front month. So we're already into that level already. So we would be getting a bit of a signal from the prices if the market was weakening considerably for the time when these barrels will start to be delivered. I think that, as Ali was pointing out, OPEC the intent is to rush to the finishing line on this 2.2 million barrels a day. The idea of slowing down is pretty unlikely, given that they don't want to be bringing additional barrels back into the market when it is weakening. So they need to really tie this up as quickly as possible. All the conversations that I've had suggest that we're still in the expedited mode. There's no plans to row back from 411,000 barrels a day. So I think that it will be continuing as we have seen over the last 3 months now.
Given that sort of expectation is so bedded in, Jamie, what are you and all of your colleagues going to ask ministers on the corridors of the OPEC seminar next week? What's going to be the dominant question? If it's not, are you going to continue to increase supply? What do you think is the question that one wants to get from this export organization next week?
I think there's a few things. One is clearly going to be how do they see demand shaping up in Q4 and Q1 next year? I suspect they will put a brave face on it and say that they're, pointing more towards the OPEC figures, which are very bullish on the demand side. But another issue, of course, is that we have this 2.2 million barrels a day, but there are 2 other layers of production cuts which are in force until the end of 2027. Amid all the discussions about, OPEC, Saudi Arabia is looking to have a market share war, I don't think we can take that kind of position seriously so long as the plan is for around 5 million barrels a day of production cuts to stay on until end of 2027. So it will be interesting to see if there's any suggestion that they might start to adjust those deeper production cuts and start to bring some of those barrels online earlier. At the moment, there's absolutely zero indications that is the plan, but I think it's something that warrants closer watch and to ask the question.
Neil, taking that point, I mean, it does seem that the supply picture, I mean, we had it from OPEC Plus in a granular memo last year, every month this amount and this from each country and so forth. On the demand side, going into the second half of the year, Trump's screaming all things tariff again. We're at that kind of red lights flashing phase. Japan seems to be on the naughty list now at the moment. And so where do you think the demand cycle is looking, given that we're on a nearly automatic supply increases coming from OPEC Plus? On the demand side, should we expect this $67 price more or less to hold, or where do you think it's going?
Well, this is the biggest problem. The Trump tariff policies has thrown a giant rock into the pool, and we still just do not know what the rules are going to be in terms of trade between so many important countries and blocs. And until this uncertainty, well, actually, I don't think this uncertainty is going to be cleared up. I just don't think it's the nature of the beast. And the market is the market is already taking account of this uncertainty, and the demand growth prospects are being pared back, although not dramatically. And in fact, in the real world, in the early part of the year, the year-on-year demand growth is not actually that bad. And if it were to turn out at give or take 1 million barrels a day, which an analyst from a firm I was talking to yesterday suggested is still the case, that will not turn out to be too bad. But there is this layer of uncertainty which Trump has thrown into the market. We're now into July. When was Freedom Day or whatever it was called, Sean? Remind me.
April 2nd, Liberation Day.
Liberation Day, that's the one. April the 2nd. We're now into July with 3 months in, and we still don't have any clarity. So there is this dramatic uncertainty behind it. But what's happening, though, is with the unraveling of the voluntary cuts from OPEC Plus gradually over the last few months, whether it finds its way into the market or not, which ultimately is what really matters, the market seems to have settled on a price in the mid to high 60s for Brent, which I regard as being a comfortable range. I don't like you use the phrase stuck in that range. No, we're not stuck. This is the market's judgment. This is the market range. It's a price which is okay for most producers. And it's certainly, I think, okay for most consumers. So it is essentially a sweet spot. And as long as the market dynamics, supply going up, demand going up, either of them going down at any point, as long as the dynamics are working in such a way that the price remains in this current range, I think actually overall that's going to be pretty good for everybody concerned.
Ali, one of the questions I might ask if I was still on the front lines of chasing ministers in corridors in Vienna next week would be, is this a good story or a bad story for OPEC Plus? Because the driver of this decision, of this accelerated increase, at least in the industry press, has been because of the disharmony within OPEC Plus, and too many countries are cheating, and so we need to increase the quotas so those cheating doesn't look as bad, and to punish those that are cheating, etc. So that's a lot of the narrative. And we've had reports to that again today, with Kazakhstan being the sort of naughtiest boy in the class. Your thoughts on where that is within the OPEC Plus countries? Of course, Oman is one of them, not in the naughty corner, doesn't get put there quite often. At least we don't hear about it. But do you think that narrative is overblown? Do you think it is driving this increase in cuts or increase in supply that's coming from OPEC Plus? Where do you sit with that?
No, I think it is overblown. I mean, we have this difference of opinion every time there is OPEC Plus meetings, and things have been discussed inside the rooms and inside, during the meetings. And once you leave the meeting room, then most of these ministers, they're trying their best is to avoid talking about any kind of disputes or any kind of differences in opinions or something like that. It's just to show the unity of the group, and that they are targeting.
So is this a good story? The idea that OPEC is being successful in managing the market
Absolutely.
here, because it seems like it's quotas catching up with actual production rather than it actually being new production. So now everything looks sort of better aligned, whereas before it was kind of like this. Now
Yes.
it's sort of looking.
Indeed. I think it is something. It is always, OPEC Plus brought a lot of good things. One of these things is to bring the alliance together, and also to try and to keep it, as much as they can inside the meeting rooms, without getting, showing the market the differences in opinions, which could affect the market. So far, I think it's a good news, and I don't think that during the meetings that we are going, or the meetings with the ministers in the corridors, that they are going to show any kind of indications that there is any kind of differences. Although that the media and also the market is talking about Kazakhstan is being a naughty boy, but they've always been since the beginning. Iraq has always been, but again, we still see that there is a kind of engagement, and also a continuation of the same group going forward. So I don't think that this will be something that the media will take long time to discuss with the ministers during the meetings, or during these meetings, or on the corridors.
Well, they'll probably try and see if they can get anybody into a wrestling match. Let's see. Yeah, we can have an arm. Jamie's good at that. I've seen him at work. It's very sharp. Jamie, one thing that's coming up a lot that I'm starting to think a lot about as being an outsider issue, and becoming maybe not so much a peripheral issue, but that is the collapsing or the weakening dollar. We're seeing a fairly dramatic decline in the dollar over the last period of this second quarter, with the sort of commitment to tariffs, the screaming that Trump is signaling that he wants to change the Fed chairman and so forth. And given that the Gulf states are pegged to the dollar, $67 is now like $60 was 3 months ago. I'm just wondering your thoughts on the outlook. If this dollar decline continues, they pass this new budget bill in the US in the coming days, further downward draft on weak dollar. Your thoughts on its relevance for looking forward at global oil demand supply balances?
Yeah, a couple of issues there, Sean. I think one, as you rightly say, the Gulf states are pegged to the dollars, so clearly there's a negative fiscal impact for them with a weakening dollar theoretically, although you have to look at what their expenses are also denominated in. A lot of their imports come from the US anyway, and as a result, declining dollar doesn't have too much of an impact on that. I think the big issue, though, as you pointed to, is the fact that oil, what does this do for oil demand? The weakening dollar does essentially mean that in the UK, pound sterling, oil prices are going to fall if they remain flat dollar denominated, same in major Asian consuming countries. So it should, all things being equal, lead to a bit of an acceleration in the demand growth trajectory if this weakening dollar comes in. I think just to circle back to some of the things that Ali was talking about as well. Your question to him there, is this a good story or a bad story for OPEC? I think as always, it's a bit of both. Clearly, OPEC ministers, there's always been disagreements within OPEC, but they still, how many times have the obituaries been written for OPEC and OPEC Plus? There are disagreements. That does not mean that they can't continue to work together on the market management front. The fact that the market has managed to absorb all of these barrels without weakening at all, even if we take out of the picture or the impact of the 12-day Iran-Israel conflict, I think the oil prices now are a lot higher than people would have suspected after Liberation Day, when OPEC Plus first announced that acceleration of the easing of the production cuts in the face of massive global economic uncertainty. So I think that overall, I would lean towards it being a positive picture for OPEC. Certainly, I think that what would happen now if they decided to slow down the easing of the production cuts is that it would be portrayed in many quarters as OPEC's getting cold feet. OPEC sees the demand picture weakening considerably, and that's why they're reversing course on this trajectory. And you might even see oil prices drop back as a result of that. So the fact that they're managing to increase at this rate, the fact that prices are holding steady is all positive for them, despite, yes, there is an element of the countries not fully complying that has factored into it.
Yep, let's go to the survey question. Oil market supply demand research and forecasting are no longer fit for purpose. It's a big statement, but nonetheless one that is putting out there some topic for conversation. Maybe it's a session at our forum in October. But it does seem to be coming up a lot in the last 2 years, and now the secondary sources are the latest ones to take a bit of a focus. Neil, looking at the outlook again for the second half and for this price range that we've been in for a while, where does that, do you think, intersect with inventories and the opportunity to buy into this price to replenish inventories that in the US, the Supreme Petroleum Reserve could do with replenishing? Your thoughts of where extra demand may come in for inventory purposes at these advantageous prices, if indeed we're in this range for the rest of the year?
Well, I've never been entirely clear why it's considered to be necessary to rebuild the US SPR, particularly if you want to rebuild it back towards the peak level of just under 700 million barrels that it hit a few years ago. That was a level established in the days when the United States was a declining crude oil producer. Don't forget, in 2005, the US produced 5 million barrels a day of crude. Now it's 13 and a half. And the US had decided on a bipartisan basis about 10 years or so ago, I think during the Obama administration, that the SPR could be reduced in size. They were doing it partly to raise money for other reasons, but
well, the OECD, the IEA rule is 90-day cover, right? 90 days of imports.
Yeah, but the US is a net exporter, so frankly, the rule is irrelevant as far as the US is concerned. But back in the day, yes, you're absolutely right. It was the 90-day rule, and the US more than exceeded that requirement, as it was their right to do. Now, as we're in a situation where US production has very nearly gone up threefold over the last 20 years, we're in a situation where whatever you think about the future of US production, it's going to remain at pretty elevated levels for many years to come. And you've got the strong growth of regional production, Canada, Brazil, where are we? Guyana, Argentina. You've got the US is sitting in a part of the world where there is actually plenty of supply and maybe Venezuela could even come back in, many more years into the future. And
Not necessarily cheap cost of production, but
well, sure, but the point is there is plenty of supply, and so I don't quite understand why they feel it's necessary to replenish the SPR back up towards the elevated levels we had before. Yes, you can argue that the Biden drawdown in 2022 was overdone, but of course, when that process was started in the immediate aftermath of the Russian invasion of Ukraine, nobody could really see where Russian production and exports might go. So it was probably a sensible thing to do. So yeah, maybe they will buy more to rebuild, but I don't think prices are yet really attractively low enough for them to do it. And it's not just a question of the volume, it's also a question of the quality. What type of crude do they want to buy and have in the SPR that the US refiners would want to use in the event of an emergency? And that raises the issue of light barrels and heavy barrels and the nature of US production. So there's a lot of issues here. As far as stocks are concerned, I don't believe that looking at the level of stocks around the world, the OECD stocks, which are very visible, and there is good data for that, Chinese stocks, which we're not too sure about, but we know it's about 1 billion barrels, stocks held in other parts of the world, there is plenty of stock on a global basis available to the market in the event of disruption.
Ali, I wanted to get your thoughts on, I mean, one of the other surprising outcomes, perhaps why the price has stayed elevated or higher maybe than people were forecasting given this accelerated OPEC supply increase, and that is that China has performed better than maybe the narrative was at the beginning of the year, that China slowdown and China's structural weakness with construction and real estate and US trade war and so forth. It's facing a lot of challenges, but still buying a lot of oil. And obviously Oman, biggest customer for most, nearly 100% of your oil exports is China. How do you see China's outlook? Better than expected, that narrative should shift to China still a major pillar of the oil demand growth?
There will always be the pillar of oil import in the future. But I don't think that they have enough growth at the moment to cover the whole demand. They need some time. The packages that stimulus packages that they did at the beginning of this year, it worked. But again, the tariff problems and also the war between America and China on the tariffs, it played a big role on slowing down the growth in China. And I think now after
it also played a role in triggering China to buy a lot of sort of security barrels, to like fill up those inventories because of oil security concerns.
Yeah, they took an advantage of the price and also the availability of many volumes of crude in the market, and they went and filled up the inventories. That is the obvious thing anybody will do in this kind of situation. But again, I don't see that there is enough growth to allow any kind of more inventories or more buying of crude oil in this year, at least up to the end of this year. They have enough oil, and the market is full of oil. Production is growing everywhere. So there will be some reaction from the market and reflecting the reality, and the price won't stay like we see it at the moment. I think the fourth quarter will drop down a bit, maybe to 65 to 66 could be, but I don't think that this is going to continue as a trend to the end of this year. There is a lot of market, Sean, in the market. There is a lot of oil in the market.
There's a lot of supply in the market. Jamie Ingram, last word to you on that, because I wanted to come back to where, in a sense, started. A lot of the expectation or forecasting in the first half of the year, and again, the commentary around the secondary sources of expectation that in the second half of the year, supply would exceed demand quite significantly, and consequently, we would be in a downward pressure. Where is Mees forecasting? Where are we seeing that sort of net supply growth or demand growth for the year. More importantly, as the data point is, last year was a demand growth of over 1.2 million barrels a day. The forecasting until not long ago was sub 1 million, maybe as low as 500,000, some forecasting. Your thoughts on where that data point looks for the second half of the year, for the year as a whole?
Thanks, Sean. Yeah, for the year as a whole, I'd say that the consensus at the moment is probably focusing somewhere on the 800,000 to 1.1 million barrel a day. I think that's probably where the smart money lies. It has been stronger than expected in the first half of the year, I would say, demand growth. And we're seeing that reflected in globally observed inventories as well. That's really where you start to stress test all these scenarios is, well, hang on, these are what our balances are showing us, but that does not tally with inventories. So either we're missing some barrels or we're double counting some barrels somewhere. So what's going on here? So I think that's really going to be the key metric that OPEC Plus is going to be following in the second half of the year is, do we continue to see inventories remain below that trend line from 2024 or the 5-year average or whichever metric you want to be following? Inventories have remained lower than most people were expecting through the first half of the year, starting to rise a little bit now in some jurisdictions, but also the data coming out of the US inventories is very bullish as well, which is obviously something that the market is closely watching. Despite, as Neil says, the US is no longer a net importer of oil, but yeah, it still drives a lot of markets, those US inventories.
Well, there we have the survey result. Disagree 64%. Fair enough. I think it's a subject worth beating around a bit anyway, as it's so critical for so much of the market in terms of expectations if they're not met, affect prices, and expectations if they are met, affect prices. So I think that is something that requires extra thought. But we have to wrap it up there. As we started out, oil prices, Brent is sort of 67.04 at the moment in Asian trade, and not moving much off yesterday. We've got a great interview coming up now with Dr. Nick Waithe, the CEO of Energy Institute. And one of the key things he points out, and we didn't even talk about because it's not immediately relevant to our conversation this morning, but it is relevant to the brief chat I had with Ali Al-Riyami of the Heat and AC in Vienna. But Nick was talking a lot about the surge in summer power demand in Europe over the next 10 plus years as AC requirements go through the roof with this new climate architecture. And like we see in the Gulf now, surging AC power demand and burning of liquids and so on to meet that, we're going to start to see a lot more of that in Europe, summer demand in a way that didn't exist before. I was one of the sort of cornerstones of his interview. I want to thank you guys so much. We're obviously wrap up the season next week around the time of the OPEC seminar. So last possible time that we'll have you guys together with us this season. Ali Al-Riyami, of course, always in Oman, bringing a great perspective to our conversation. Thank you for all your words and insights this season, Ali. Have a great summer. Neil Atkinson in beautiful Paris most of the time, but in the UK today, I think. Neil, as always, thank you so much. Enjoy watching the Lions. It should be a bit of fun. Jamie Ingram, as always, congrats on your promotion this season to managing editor of Meath. They're very fortunate to have you, one of the best journalists in the business. So thank you so much, Jamie, for your contribution this season. Hopefully see you in Vienna. Take care, everybody. And every morning, 10:30.